A very good afternoon to all friends. I'm Sanjeev Singhal, Chairman of the Auditing and Assurance Standard Board. On my behalf and on behalf of the AASB and my Vice Chairman Vishal Bhai Doshi, I welcome you all to the 112th program of AASB for this council year. In about 4 months' time, this is our 112th program, and we are bringing to you altogether brand new topics. And friends, we have recently also approved an audit tool with the name of Any Audit. It's significant discount for our members in practice, and up to 3 users and 6 audits, it is free of cost. And after that, there are significant discounts for smaller firms and slightly lower discounts for the larger firms. You may kindly test the software. It enables you to document your audit work, and because we know that audit documentation is the insurance for the chartered accountants. Unless it is documented, it is considered not done. We are also doing a practical workshop on the same on 8th of this month on a physical mode at our Faridabad branch. So those who are in Delhi NCR may join the practical workshop as well. Friends, today's topic is an altogether new topic. It's audit of startups. Because now the startup is the buzzword. We have many unicorn. We have many decacons also in the making. So the question arises is that what are the special consideration in the audit of startups? And to discuss this topic, we have 2 youngsters today, CA Vineet Jain and CA Rahul Chaudhary. Vineet has been our speaker on outsourcing largely, but outsourcing is also a startup. So we requested him to now speak on the audit of the startup, the special consideration as they see. And of course, same goes with Rahul. And we have 2 young moderators today, CA Akash Kumbar and CA Apur Gupta. Apur has been with us in the past also. And, when I see these youngsters taking up time for the audit, I really feel happy because, we need a lot of young talent in audit. And through these programs, we are trying to develop new speakers, young speakers, experienced speakers. And so far, we have been trying to develop about 250 new speakers every council year. And this trend is continuing. We invite those of our participants who would like to be the moderator or the speaker to reach out to us, send their videos of 5 to 10 minutes on a technical topic so that we can evaluate and make you part of this being a faculty or a moderator. With this, I would like to sincerely thank both the speakers and the moderator, and especially Anil Lalji, who has been organizing all these programs very diligently, talking to all of you, organizing these programs, and spreading knowledge across the globe, and particularly in India. So I'm really happy to see all 4 of you on this screen, and may I now invite CA Apur Gupta for taking the proceeding of this session forward. My sincere thanks to all 4 of you. Thank you.
Thank you, sir. And I would like to thank our CA Sanjeev Singhal, sir, our our chairman of AASB, and our vice chairman, sir, Vishal Doshi, sir, also. And I would also like to thank CA Rahul Chaudhary and CA Vineet for being a part of today's webinar to enlighten us on the audit considerations of the startups, which are very important and very critical to analyze for the audit procedures with the dynamic changes we are having and with all the deductions and all the parameters there are available for the startups. So I would like to thank them, and I would like to introduce CA Rahul Chaudhary, who is our speaker today. He has been a partner in Big Fours for more than 18 years now. And he's been with Deloitte for more than 17 years now. He has a wide experience in financial reporting, IPOs, international reportings, fund reportings. He is the lead accounting operations assurance, and he provides innovative initiatives for the Deloitte Assurance in India. He has been a part of CBDT constituted by a government committee on the issue of new tax accounting standards and ICDS for India. He has worked in multiple AMCs, hedge funds, PEs, mutual funds, REIT funds for large investment banks also. He has strong he has a strong suit in IFRS, Indian GAAP, and US GAAP knowledge also. The client relationship management and the project management skills are his good areas where he excels. And I would like to thank him for being a part of the webinar today. Now I would like to invite C. Akash Kumbhat to take the webinar further.
Thank you, Apurv. Good afternoon to you all. First of all, I would like to thank CA Sanjeev Singh sir, Chairman, and CA Vishal Doshi sir, Vice Chairman of the Auditing and Assurance Standards Board of ICI, for giving me the opportunity to be the moderator today. I would also like to thank all the participants and our exceptional speakers as we have some cutting-edge topics to explore with them. Let me welcome CA Vineet Jain sir to you. CA Vineet Jain sir is a commerce graduate from University of Delhi. He is the CEO of Hemsworth Consulting, where he focuses on recommending and implementing effective organizational strategies. He is known for his meticulous attention to details, which he believes is essential for delivering top-notch solutions and services. His work spans statutory and internal audits, financial reporting for publicly listed and closely held corporations in India and the USA, and improving process and performance efficiency for major power and mining companies in the CIS region. Over the past 3 years, he has specialized in US taxation and compliance, helping with a range of corporations and startups navigate these complex areas. We are fortunate to have these two accomplished professionals with us today, and I am sure that their insights will be invaluable. Without further ado, let me welcome CA Rahul Chaudhary sir for his deliberation.
So thank you so much for the kind words, Sanjeev sir, and thank you so much for the kind words, Apurva. It's nice to be in front of the fraternity. I think what gives me immense pleasure is Sanjeev sir. I think still to be called a youngster. So I think this is something which has given me more happiness today. Let me start sharing my screen, and I hope everyone will be able to see the presentation. Yeah.
Yes, we are able to see the presentation.
Excellent. So whenever I have to speak at any forums, my first half an hour just goes in thinking what should be there in the first slide, what picture should be there in the first slide. And this time I chose this picture. You will hear me for the next 65 to 70 minutes. So I was told that this is a one-way webinar, but I have included some ways where we can do some interaction, and I'll take pauses and I'll request you guys to think all my fellow team members who have joined and then continue with the session. So why did I choose this picture? So we're talking about startups, we're talking about audit of startups, and I assume and presume that we have a lot of auditors amongst us. We might have some of you who have joined startups. We might have people who have been in industry playing different roles, right? So when I think of audit of startups, I think this picture really resonated with me. As an auditor, I think you typically look at things which have happened in the past and make your decisions basis that, right? But when it comes to startups, you can't just look at the past and drive your car, right? Just like driving your car, you can't just drive the car looking at the side mirror. You can also focus on the road ahead, right? So as an auditor of a startup, I think this is something which I feel is very critical to keep looking at the past, but at the same time, to have vision on the road, how the startups are growing, how what they are doing, and just being closely associated with them so as to do the right audits for these startups. Apurva did speak about me, so I'll just maybe spend 30 seconds. It's been almost 2 decades for me in the Big Four space. I've been working a lot on audits and assurance and for reporting stuff, etc. So Apurva covered all of that. This is how you can find me on LinkedIn. This is how you'll find me on Facebook. So I live with my wife and my daughter. I'm based out of Gurgaon and would look forward to and be happy to meet some of you if you're here. In terms of this space, like I've been really lucky. I've had the chance to work with likes of Zomato's and urban companies and Mama, Pristine Care, Cisco, HP, Intel, PhonePe, Goldman Sachs, HSBC, JP Morgan, quite a few of organizations, and I'll bring some of my experiences and no, and some of the things I've learned there with this group today. So what is it that we are going to talk about today? So we are going to talk about three things. I'll spend some time talking about the whole startup ecosystem in India, some statistics, some excitement. And then we are going to talk about some of the reporting considerations, what we should keep in mind, like as an auditor, as when we are doing audit of startups, emerging growth companies, etc. Vineet is going to talk about controls and governance consideration, going concern considerations for audits of startups. And then we will be opening up the floor for Q&As. So this is what we plan to cover today. Moving on to the startup ecosystems in India, what I would like to do is to make it interactive, I would want you guys to come and open this link, menti.com. So this is a survey mechanism. Like you can just enter menti.com on your mobile phone. You will be asked a 8-digit code. And this code is 3282134. So I have about 7-8 questions like which I have prepared for this session. And I would be including those questions at different points throughout the next 60 minutes. So if all of you can just take out your mobile phones and go to menti.com, the question you have to answer is what name comes to your mind like when you hear startups. So any word which comes to your mind, any name which comes to your mind, if you can maybe start taking out your phones and start using Menti. So I repeat, you have to go to menti.com and use the code 32821324. So I'll give 30 seconds for people to figure out how to use this. So the code is again 32821324. So I see answers are pouring in. So yes, when we talk about startups, the first thing like which comes in everyone's mind is innovation, right? With startups, I think they are trying to solve like some problems like which is a problem for the mass at large, and they are coming up with some innovative ideas to solve that problems. Employment generation, yes. I think I was just looking up before this this webinar. I think there are multiple jobs which are being created by startups, just by the startups which are registered with DPIIT. The number was the 6-digit number, like additional jobs created this year. Risk, yes. I think like this is something which I like. I see risk on this screen. I see Shark Tank. I see technology. Yes, I think technology plays a great role when we talk about the whole startup ecosystem. I see some names you have put in. You have put the names of Paytm and Mama Earth and Pine Labs and Boat, Airbnb, Zomato's. Yes, I think these are some of the more popular ones. So here is what I think comes to my mind like when I talk about startups. So growth, innovation, solving complex problems, young companies, and one thing like which also comes to my mind is risk and failures. So this is something like which is congruous to. I'll stop the voting now. And I'll move on to the slide again. So yes, when we talk about startup, all these things come to our mind. Uh, if I talk about India, like India has emerged as the third largest ecosystem for startups globally. Uh, three of our cities are in the top 30 global cities, like to be in terms of startups. The first one, like, will be no surprises. Bangalore, like, which is, I think, the rankings like keep changing, but Bangalore, followed by surprisingly Delhi and Gurgaon, like, is the second most popular place, followed by Mumbai. So these are the three top ones which appear, and like amongst the top 30 in the globe, I think they are there. The first one, of course, being the Silicon Valley. This is one sector like which has been growing at an exorbitant pace. I think the sector is growing. The sector is inviting a lot of money. Again, I was looking up just this first quarter of 2024 alone. The startup e-commerce space like attracted an investment of $2.7 billion, right? So $2.7 billion, huge investment. The count has been growing ever since. The growth has been superb. A lot of investors coming in, a lot of private equities coming in. And if we talk about sectors, almost like we see startups in all sectors, BFSI, retail tech, health tech, automotive. But one clear theme is that the real place like where we see a lot of startups coming up is something to do with fintech. So fintech has been the leader and has been the most popular when it comes to the startup space in India. Just looking up some data as per DPIIT site of India, we have 127,000 plus startups. Again, a place where we have a lot of women entrepreneurs. So I was just doing some reading, and this is a number like which is ever increasing in terms of the number of women entrepreneurs in startups. I really wish that when we do it in the next couple of years, this number crosses 50%. Yes, I think as some of you mentioned, this is a great avenue for new jobs, and Bangalore, Mumbai, uh, and Delhi are the leaders when it comes to startups. Now, the second question I have for you, you have to go back to Menti now. The same code, 32821324. So, any guesses like how many unicorns are there in India? So, number of unicorns in India. So, you have to do the same thing again. Go take your mobile phone out, type menti.com, use the code 32821324, and you can start going there again. Yeah. So we see answers are coming in. So many of you must be wondering, like what is the definition of unicorn? Uh, Sanjeev spoke about a term decacorn. So what are these, right? So the right answer here is 114. So again, like the number will be somewhere between 110 to 115. We have had some cases where some of the startups have lost their status of unicorns. Some new one keep coming in. But like we have somewhere, I would say between 110 to 115 unicorns in India. Uh, so you'll keep hearing this term startup, you'll keep hearing this term unicorns, unicorns, decacorns. Surprisingly, we don't have a very solid definition of startups yet. As per DPIIT, I think they've given some basic guidance. They should be in existence for less than 10 years. Their revenue should be below a certain threshold. They should be registered as a LLC or a LP or a company, etc. When these guys get a valuation of $1 billion or more, they become a unicorn. And in India, alone, there are 114. 2021 was a bumper year, but the year after COVID, and we had the most number of unicorns in India that year. And when they cross $10 billion valuation, they become a decacorn. So again, I think India has about 3 to 4, I would say, decacorns, and a really, really uncountable number of sunicorns who will cross the number of $1 billion soon. Now, so this was just a little bit of dope around the startup ecosystem in India. Now, we'll come to our moot topic for the day. As an auditor, what should be in your mind, and what is it that all of us as auditing fraternity and reporting fraternity and assurance fraternity should keep in mind? So time to take out your Mentimeter again. So this time, I want to hear from you, what are the challenges in audit of startups, what this group feels. Same code, 32821324, 32821324. Then we have some answers, 32821324. I hope everyone has been able to figure out how to use Mentimeter. So you need not answer 3. Even if you answer 1, you can go ahead and submit your responses. Right. So many of you think valuations is something which is a challenge. When you're auditing, what is the right valuation of the startup, of their investments, of different assets which they might be possessing. And Vineet is going to talk about going concern. Sanjeev mentioned that the famous auditing phrase, right? Work not documented is work not done. So documentation is a problem. Internal controls, fraud. I see answers around, I assume, low audit fees. Controls is something which many of you have written. A lot of risk factors, governance versus growth speed. Yeah. So I now this is interesting. I'll let you guys reflect on this one. So the challenges in audit of startups, lack of established processes and controls, inadequate financial documentation. It's a big list. You can go through this. Now, this is a question I had asked Chat GPT that tell me what are the challenges in audit of startups, and it gave me this amazing listing. So I personally use it all the time, and I think the challenges Chat GPT has listed down for me is absolutely bang on. Established processes and controls. I think one of the biggest challenges, we know that their business keeps growing. We were talking about the growth story, but many times with the growth of business, they don't have adequate and enough controls, and the right level of processes to support that. So the whole support system and the corporate services scheme is not really that adequate. Documentation is a big challenge. So through the course of the discussion, I'll talk about a few more specifics in the space of revenue and ESOPs and others, and how a lot of decisions are taken in cafes, in informal meetings. And as auditor, you go and ask for this documentation for those decisions, you'll not find them. Decisions would have been taken in board meetings, and then there will not be any enough minutes. There will not be a lot of documents or contracts which might be missing. So yes, financial documentation is really big problem. Interestingly, some of you had called out they have complex and evolving business models. So you pick up any of this, the names like what some of you had mentioned, and they have really complex business models. So as an auditor, first you need to really understand what is the business model, and that is something which will have a big implication in terms of what really construes as their revenue, who are their customers, what sort of contracts they have got into, what are the different schemes they have, for what all you should do provisions and not and what not. So that is something which becomes a complex exercise. So for an auditor to understand that business model is really essential. Going concern assumption is something which is big. In fact, if many of you Google and look up that which are some of the biggest startups, e-commerce unicorns in India, surprisingly, you will see the name of an edtech company, which at that point of time in 2022 had the valuations of $20 billion plus. And today, it's not even $1 billion, or it's I think it's might be flirting with a few $100 million valuation, right? So I think its going concern assumptions becomes a big challenge for startups and emerging growth companies. Limited financial history. So whenever you, as auditor, you have to draw up trends, wherever you have to draw up any sort of if you have to do some variance analysis, I think it becomes a big challenge in terms of what do you do about that. Valuation of assets and liabilities is a challenge. We'll spend some more time later during the course of the session on revenue recognition issues, on ESOPs, on the compensations and payouts, which happen especially to the KMPs. Inventory will turn out to be a big problem area for startups. So they have issues where some of their inventories will be lying with the likes of Amazons and Flipkarts, and how do you do the reconciliation? What do you do for physical verification as an auditor? So some of these challenges come up when you encounter startups audit. Regulatory and compliance issues is another big one. So you will have acquisition is very popular in this space. So as you dig deeper, you'll see that the necessary approvals were not taken from the Competition Commission of India. There are so many RBI compliances, FEMA compliances, etc. So invariably, if you check, I think there might be challenges around GST, around different taxes. So the regulatory and compliance is a big pain point for startups, and and not on top of their agenda in terms of the CXOs for them to fix, and therefore becomes a big pain when it comes to audit. And I think some of you had mentioned earlier as well, typically this is the space where you have a very high staff turnover. So people come and leave when you go and as an auditor go to these startups, you'll not find people who had really entered into the transaction. The documents are not so clear. So I think the high staff turnover comes out as a big risk and a challenge when you talk about startups and the auditing for startups. So these are some of the top ones which are there. Now, in the next half an hour, what I'm going to do is I'm going to now boil down and deep dive on some of the reporting considerations, and what are some of the things as auditors you need to keep in mind, what are the different models which exist in India in terms of these businesses, and some of the things as auditors you should keep in mind. So moving on to the next section. Now, again, time for one more poll on Menti. So what are the complex accounting areas you have seen in audit of startups? So I repeat, what are the complex accounting areas for the audit of startups? So many of you feel revenue recognition, ESOPs, expenditures, whether they are genuine or not, fair value measurements. I see an interesting point, CCPS. There's one interesting point. I don't know how to interpret that, which says books. Maybe I think the point is having the right books of accounts for auditing. Right. So I clearly see the trend. Most of you are saying revenue recognition, expenses, fair valuation. I think like this seems to be the view around accounting areas. So in my experience, I have listed down about 7 of these areas, which like are typically complex when it comes to accounting and auditing for startups. I think like the most typical one is revenue recognition, then around equity versus liability classification of CCPS, around ESOPs, around inventory, around fixed assets, around intangible assets, and provisions and expenses. And an overarching theme, like which is always there, is around reconciliations. So these are the areas on which I'm going to deep dive now and spend time on each of them. So let's talk about revenue recognition. And I think like as an auditor, this is something like which is the biggest focus area, which is the biggest pain point, which is is something like which is very critical for any organization, right? So as an auditor, like what are the challenges this group feels on auditing of revenue for these startups? Right, I see some interesting answers. Accounting for subscriptions, gross versus net, discounts. sales returns and refunds. Bad debt. Right. Peculiar transactions, operating versus non-operating revenue classification based on understanding of business. So let us look at the overall revenue recognition guidance and then some of the challenges and considerations like what will be relevant for audit of revenue. Now I'm going to talk more around Ind AS and a little lesser on Indian GAAP. Hope that is going to be okay with this audience. So when we talk about Ind AS, IFRS, for and revenue recognition, like broadly, I think this is the principle, right? Like you have to, there's a 5-step methodology which has been described by the standard. You have to identify the contract, you have to identify the customer, you have to identify what are the different performance obligations in a contract. Once you've identified the different performance obligations, you identify like if there are any variable considerations, essentially how do you treat discounts and how do you treat the different schemes which typically these startups would be running. Then like at what point should you record these transactions, whether like at a point of time or over a period of time, and how do you allocate the consideration for each of them, right? Like this is overall like what constitutes the revenue recognition principles. Now, for a startup, like I've just listed like some of the challenges and then I'll take some examples and we'll talk about this. Now, the first biggest issue, which like I feel and when I even talk to all my audit partners who do startup audits and emerging growth company audit, the biggest issue like and the challenge like they face is this whole gross versus net revenue recognition. So what are we talking about here? So if you think of different business models, right? Like if you think of the business model of let's say a Zomato, right? Like they provide you an app. With that app, like you can order food. You have paid, let's say, 1,000 rupees for your food. Now there will be different people like who will be providing the service. So there will be a restaurant partner, there will be a delivery partner, there will be Zomato. At what value like should Zomato record their revenue, right? Like in this 1,000, like should it be 1,000? Should it be let's say if their commission is 15%, like should it be 150? Should it be 150 less like whatever payments they're doing to delivery partners? If like they're making margins in delivery partners, so should they in the fees for delivery? So there are these different models like which exist, right? Like if you think of urban company, similar, right? Like you go and get a haircut, the price is 1,000. Or rather, you call someone and get a haircut, the price is 1,000. Urban company might be charging a commission of 150. So whether their revenue should be 150, their revenue should be 1,000. I think this becomes like the first and the most important item as an auditor, like what one encounters is this whole gross versus net for revenue recognition. Now, the principle has been very well led in Ind AS, in IFRSs. It talks about identifying like who has the principal responsibility for incurring the service, who has the inventory risk, who has the credit risk, who has the price risk. So these are the questions one needs to ask. And once you ask this, you will get the right answer. Now, in most cases, we have seen that it is very difficult to get into a gross revenue recognition for especially like the service-based startups. So I think like it requires careful evaluation in terms of this gross versus net. Now, this is why I'm talking about this issue right upfront and like why this I feel is the most critical issue. Now, if I talk about materiality, right? Many of the startups would typically be incurring losses. Now, you can't use profit as a criteria for identifying materiality. So you will end up using a bunch of items like revenue or total assets, etc. Now, you go ahead and do your audit with a certain assumption, like with a higher revenue assumption, like with assuming that gross revenue was the starting point. But the moment you conclude net, everything goes for a toss, right? As an auditor, like all your audit procedures essentially will have to be redone. From a startup's perspective, like they might be projecting to the world that their revenue is 100 crores, but once you do net, like you might be surprised to see that their revenue might be only 20 crores or 15 crores, right? So that is, I think, something which becomes very difficult. Now, there are a lot of practices, I would say, which have evolved in terms of this gross versus net revenue recognition. There are also implications on taxes, especially GST, in terms of what do you do for this, so in terms of gross versus net. So what many smart companies have done, smart startups have done, I think like they have now taken some good positions. So if I just pulled out a few sample invoices which are available on public domain. And if you look at it, this is for one such case, like where they clearly call out that their customers and their clients are like whether the final customers or the service providers, right? And they issue invoice now like only for their portion of the service. So this is an example of one of the emerging growth companies. So essentially, if you see, they now issue two invoices. So they have one invoice like for the service charge, like where they mention that this is invoice on behalf of the partner, and then they mention that this is an invoice on their behalf, and then like they issue their invoice for their fees, like where they very clearly call out that this is the GST, this is their portion of fees, or this is for the platform, or this is for convenience or use of the thing. So as an auditor, we need to look into these. We need to look at and read these terms and contracts. So if I just read what this company has called out, the services include the provision of the platform that enables you to arrange and schedule different home-based services with independent third-party service providers of those services, which is service professionals. As a part of the services, they facilitate the transfer of payments to service professionals for the services they render to you and collects payment on behalf of such service professional. So if I just apply as an auditor my lens, right, like in terms of gross versus net, principal versus agent, this company is clearly calling out that they don't have the principal obligation of the delivery of service. They are collecting payment on behalf of the service professionals. They are clearly not holding any sort of credit risk, and then like in this case, like it is more likely that they will be an agent, and they should not record revenue gross. Similarly, if we read the second paragraph, the services rendered by service professionals are referred to as pro services. The term services does not include the pro services. The company does not provide the pro services and is not responsible for their provision. Service professionals are solely liable and responsible for the pro services that they offer or otherwise provide through the platform and its affiliate, and do not employ service professionals, blah, blah, blah. So I think this is an example like where the company has gone ahead and very clearly called out that what is their roles, what is their responsibility, and this evaluation becomes simpler, that whether like the revenue should be recorded net or it should be recorded gross. But many times like it is not clear as an accountant, as an auditor, that whether you should record gross or net. So this is one area like which also I would say involves significant judgment in terms of whether the revenue has to be defined, has to be recorded gross, or it has to be recorded net. Now, the second big issue, like which comes as a big challenge, like for this industry, is like this whole concept of variable consideration and like the possibility of netting. So there will be a lot of these discounts like which will be offered to you. There will be a lot of rebates. There will be refunds. There will be all sort of issues, like all sort of items which will be there. So the question which comes is that some of these items, like whether these will come as a separate line item of expense into the P&L, or like it will be coming as a reduction of revenue. And even like if you're talking about reduction of revenue, to what extent like can you go ahead and reverse these revenue? So this is something like which becomes very challenging and becomes interesting. So let's take the same example, the food delivery app what we have. Now, let's say in an example like where their total invoice value is 1,000 and hypothetically their commission was 150. Now, there was a problem in delivery, and like the customer is not happy. They call the delivery, they call the company which has the app, like the food company, and they ask that please give us refund, or like they are unhappy, and the company goes ahead and gives a rebate or a refund of 400. Now they earned 150, but they have paid out 400, and assuming that that can't be recovered from the restaurant partner. So should you net off the entire 400 against the revenue of 150? Should you net off 150 against one revenue, and 250 should you show as a separate line item as an expense? So this is one example like which as an auditor, like you need to be careful. There are some ICAI guidances on how do you do about it. Similarly, I think like there will be lots and lots of issues like which will keep coming, like when you talk about this possibility of netting. So there will be some refunds, there will be customer returns, discount schemes, etc. FOC items. So how do you deal with those? For let's say like companies which are into goods and not services, like for them, like one of the additional item becomes this whole returns, and how do you distinguish between what is a return, like what is a bad debt, what is a discount, and what is a scheme, etc. So this is something like which becomes quite interesting. So I'll request this group to think over this question now, that amongst these items, trade discounts, refunds, FOC items, sales returns, bad debts, reward points, cash discount, what are the items that may be netted off against revenue, and which are the items like which need not be netted off and like can be shown as a separate expense item? So yeah. Just to be clear on the question again, we are saying that which of the items should be netted off against revenue, and which items need not be netted off against revenue. See, the answer is that other than bad debts, actually every item which is listed here, trade discount, refunds, FOC item, sales return, reward points, cash discount, etc., can be technically netted off against revenue. It will depend on situation to situation. But like if I talk about discounts, both trade discounts and cash discounts are to be netted off against revenues. If there are sales returns happening, even that has to be netted off against revenue. Now, not only the actual sales return, even the provisional sales return. So anything like what you have sold and like for which you expect that there will be sales return in the next period, provision of that again needs to be netted off against revenue. The only exception like in this list which need not be netted off is actually bad debt. So there, I think like the guidance is very clear that the bad debt needs to be presented as a separate line item in your expense item, and like it should not be netted off. The next issue, and I think this is something like which someone had also called out in challenges, was this whole treatment of the membership fees, whether it is to be recorded upfront or whether it is to be recorded, whether it is to be deferred. So think of an example, Cult Fit, where you pay upfront, let's say 20,000 rupees for using the subscription for 10 months. So whether like you should record as Cult Fit, like whether you should record that revenue upfront or you should spread it over the period. Now, if you think of if Cult Fit, I think like the answer is clear. You'll say that it has to be done over the period of 10 months. Now, the challenge comes like for anyone who uses Cult Fit here, that there will be multiple performance obligations, or rather there will be multiple services you can use. You can use their group classes, you can use their gyms, you can use their play areas, etc. So how do you allocate revenue, and like which portion of revenue do you record when? So that is again like a question like which comes, and that is an issue like which needs to be resolved. Like when you're talking about this one. Again, a lot of edtech companies charge you upfront for the fees, but then like I think you will be as a consumer using that service or using those products, getting those trainings over a period of time, right? So I think like this becomes an important consideration as an auditor, like whether you should record the fees upfront or you should defer it. Similarly, like one area where we have seen like a lot of debates issues is around franchisee fees. And again, like what we have seen is people and companies have started becoming smarter. So the obvious answer is that membership fees, franchisee fees, like can be deferred over a period of time. But then I think like what people have done, like they have started linking instead of like calling it out as franchisee fees. They have now started saying that with this franchisee, like you get, let's say this much product of my company free. Now, the moment you have done that, like you get a situation like where you de-link the whole upfront money received against the franchisee fees, and like that becomes more like a consideration for the free of cost goods what you provided. And in that case, you can go ahead and record revenue upfront, like again a possibility. So that is something like which is tricky and like which will require some evaluation. Likewise, I think like if you guys have been using let's say things like Easy Diner or Dine Out, right? So you pay a fees upfront, let's say 1,000 rupees for 12 months. But then, like as Easy Diner or Dine Out, you'll not know that what will be the use of the usage trends of the customer. Whether they'll use that upfront, like some customer can go and get a discount in their next restaurant bill, and which discount is 1,500, and that completely knocks off against your fees what you have received. Or like how do you do that estimation that how will the customer actually use that dine out benefit or easy diner benefit? So the more complex business models are there, the more difficult it is to look at the right sort of revenue recognition for these companies, right? And then that's something like which throws a lot of challenges. The last piece I'd like to talk about on revenue before moving on is this whole concept of ECL and bad debts. Under Ind AS now, you just don't make provisions for actual bad debts, like you also make provisions for, like in banking, you have standard NPA, a 0.25% provision. So like that, I think you also make provisions for good debts today, which have a probability of becoming bad debts in the future. So how do you get data for that? How much period you go back, like with the businesses changing so fast? I think that is something like which we have seen. Many people just simply go by age-based provisioning, but then I think like they have to go ahead and use some simplified approaches for bad debt. Now, like one recent transaction, like which was out in public, and I'm talking about a startup like which was essentially providing mechanic and repair services for your car. Like they were in the news for some sort of fraud. And one of the risks, like which always is there with revenue, is the whole genuinity about of that revenue, right? Whether like there are any ghost understatement of revenue or like even overstatement of revenue. Now, so very interesting fact patterns for this group. So what was happening? The company like was actually siphoning cash by inflating the revenue. Now you will wonder that if you're inflating revenue, like how are you siphoning cash of the private equities? So what this guy was doing, like let's say it was an emerging company incurring a lot of losses, and their claim was that let's say like for earning a revenue of 1,000, they're actually incurring a cost of 1,500. So they started showing bogus incomes and revenue of 1,000, a bogus expense of 1,500, and a notional loss of 500 sitting in their books, like which was not actually happening to bogus vendors. And this was the way for pulling out that 500 rupees cash, right? So lot of interesting business models, and like therefore a lot of increased risk, like when you talk about this whole revenue recognition for the e-commerce company. So I think the list is pretty big. I think keep talking about revenue recognition. Maybe I'll shift on to the next one. The next typical issue, what we see like as a challenge for startups is this whole issue around ESOPs. So this is one area like where most startups, e-commerce companies incentivize their founders, their employees that who have joined earlier, the co-founders, etc., and like critical employees and even non-critical employees by issuing a lot of ESOPs. So this is one area like where which requires careful audit consideration. The first like and the biggest problem what we have seen is no documentation. There is, as an auditor, like if you say that where was this ESOP given to the CEO of the company, the answer is in a board meeting for which there is no minutes. Or like I think like it is not clearly called out like what are the terms of ESOPs, like what will be given to the CXOs or to the critical employees. So documentation is one of the big challenges when it comes to ESOPs. Now, there are a lot of other challenges which keeps coming in. We have seen that the whole ESOP has been classified incorrectly. Cash settled being qualified as equity settled, and equity settled qualified as cash settled. And like there's a big implication in terms of P&L, right? What do you do about that? Many companies continue to account their ESOPs by intrinsic value approach, like which is not so popular anymore. And the whole implication is that there is an undercharge and your profit is inflated because of this matter. Now, in a cross structure, like where there are parent subsidiaries, we see a lot of time like where subsidiaries employees are getting ESOPs of parent, but then like that whole accounting is missing in the books of subsidiary. So there are two possible scenarios: a cross-charge scenario, or a scenario where it is not cross-charge. And we see that typically subsidiary don't even account for this. And like as an auditor, like also if you don't ask, like then the whole profit is overstated. Likewise, there are complexities around like what is the right grant date for these ESOPs, what are the right valuation options, what one needs to use. So different options like can have different valuation options and will give different answers. So as an auditor, like we need to be sure that when to use Black-Scholes model, when to use binomial, when to use Monte Carlo model. So that is something like which is important as an auditor, as an accountant. Now, the fifth box like is where like I want to spend a little more time, which is the inputs required for valuation. So many times as auditors will simply say that we are the auditors, like there is an external valuer who has done the valuation of ESOPs. Why should we be considered, why should we be worried about the whole valuation? Like we'll get the valuation report and we'll be good with it. So that's not correct. As an auditor, we need to challenge like the assumptions which have gone into that valuation. Now, one of the areas like where I've seen like mistakes happening all the time as an auditor is like the is the time what they use for this valuation, like this concept of T. So typically, if you look at Black-Scholes model and then even if you look at this slide here, like this is just I pulled out some of the inputs which people use for their ESOPs. So they use dividend yield, they use volatility, risk-free rate of return, and expected life of share of options. Now, many times, like what I have seen is that an option like which is let's say issued at start of year one for a period of 3 years, and like the vesting date is clear, like vesting period is 3 years, but then like there is an exercise period of let's say 4 years. So most cases I've seen that like when the valuations are being done, like it's being done just assuming that the life of the ESOP is 3 years, and all the assumptions of volatility of the calculations are done using that assumption. But as an auditor, like we need to see that what is the expectation of exercise of those options. And like if the trend is that that most of the people will actually exercise the option somewhere between year 3, rather year 4 and year 7, we need to use a time frame like which takes that into factor. So the real risk-free, the real time what has to be used for all discounting for all ESOP valuation purposes will not be 3, like it will be somewhere between 3 to 7. And if we expect that it will be straight lining over the period of 4 to 7, when all the employees will exercise their option, then like you might actually use 5 years as a period for valuation. So as an auditor, like we need to challenge that assumption. Likewise for volatility. Now, like volatility, if you change volatility by a couple of percentages, the whole valuation will also change by a much higher percentage. Now, whether you use the volatility for 5 years or 1 year, etc., like it's something like which one needs to also you look as an auditor, right? For you to get the right valuation of the valuation of these options. So ESOP, I think like one of the most popular ways of incentivizing the employees of startups is again like one of the most critical items when it comes to audit, and like when it comes to areas like where there can be potential errors and potential frauds. The next favorite area for auditors and like areas like where there are a lot of issues is inventory. So in inventory, like we encounter a lot of issues, and this is especially like for product companies. So let's like you take any example, like any example of a e-commerce company of a company like which is selling through multiple channels. They would essentially be listing their products on let's say Amazon and Flipkarts and Snapdeals, etc. And what this means is that their inventory will be lying at different places. Now, as an auditor, like for you to get your entire arms around like where is the inventory to do physical, to request management for physical verification, for you to do physical verification, it becomes a big task. Now, what this results is in that typically like if you do a physical verification versus the inventory in ERP versus the ERP in the inventory management system, like you find that all the three are not tying. So in typical scenarios, that you only have to worry about two things, about your ERP and your physical verification reports. In case of startups and emerging growth companies, what we have seen is the additional problem coming in between the reconciliation of inventory management system, ERP, and physical verification. And like there are so many reasons for this, right? So their business model is such that let's say they have sent the product to the likes of Amazon and Flipkarts. The product have been returned. The return has not been taken into account, or I think like many times when it has been returned, like incorrect quantities have been taken into, or like it has been entered into either the inventory management system or the ERP. Likewise, I think for replacements and product returns, many times the return comes, rather the return has been made, but then like that has not been included back in your inventory. So that becomes a problem. Delivery failures are one of the popular issues which happen in this space. So this whole reverse logistics and this issues around reconciliations and where the real inventory lies is a big problem and a challenge for these emerging growth companies, and therefore like a big issue for auditors. Now, the other issue which happens is this whole issues around identifying as an auditor, like what is your slow-moving item and what is how do you create provision for obsolescence for these items? The challenge is that some of these items, like for some of these startups, will have like so many SKUs that like it becomes difficult, and especially like for the inventories which are lying with third parties. So for them to identify like what is the expiry date of those products, what is the aging of those inventory, like typically like they don't, most of these startups don't have a ERP or a inventory management system where like they have batch wise production details available of all the inventory, especially like once it has left your premise from the first time, whether it goes to third party or the likes of Amazon, when it comes back, etc., it becomes very difficult. So for you as an auditor to really get the correct aging, to identify which are your slow moving items, to identify stock lying at third parties is critical for you to carry out the right obsolescence provision and then like I think that becomes a big challenge. Likewise, I think like how do you create the provision for sales return is something like which is a big challenge like when it comes to inventory. Now, what happens in many cases is that that let's say as an auditor, now the next question is that you actually were smart, like you identified and you go ahead and get these things updated. The next question which plagues you as an auditor is that like when you do this course correction, whether some of these things will qualify as an accounting error or whether this will qualify as a true up of something like of something which should have been done correctly earlier itself. I think like that becomes a big point, a big moot point for discussion. And then whether to show it as an error, whether to show it as a change in estimate and do it prospectively, that becomes the second point. And then identifying and making the right provisions is a big challenge. Now, one very recent example, we were dealing with sales return. We identified client is not making a provision. Now, for making a provision, like how far do you go back for identifying the trend? So some companies like use that, okay, like as of let's say 31st March, if you have made sales and like there is a life, there is an expectation that the product can be only returned in the next 3 months or 6 months, you go back and only check for your sales of last 3 to 6 months and like make provisions for that. And like if you use that as a percentage, your denominator of revenue will be very different and the sales percentage will be very different. Versus, let's say, if you use a denominator of 12 months to find out the trend, your numbers might be completely different, right? So as an auditor, I think one realization, I think what we have had is to always be conservative for some of these numbers and for some of these calculations, so as to come at the right numbers, right? Moving on, how do startups raise money? So I think like we're running a little behind time, so I'll not go too mentally on this one. But typically, I think there are different sources by which the startups raise money. Like one is, of course, equity shares. But the more popular one is actually instruments like CCPS and OCPS CCD. What are these instruments? Compulsorily convertible preference shares, optionally convertible preference shares, compulsorily convertible debentures, optionally convertible debentures, and like and then different variations of these. And each of these instruments like has many further variations. So in a CCPS, there will be variability in terms of the coupon rate. There will be variability in terms of time of conversion or like redemption option or like a down turn right. So there will be a lot of complex, I would say, accounting implications of the terms of this CCPS and OCPS and CCDS, CCDs, etc. And that will have a huge implication in terms of the accounting and the final reporting, what finally comes out in terms of CCPS and CCDs. So most commonly what we have seen is that most of these e-commerce companies, startup companies, go and end up classifying their CCPS as equity. But if you analyze the contract, if you analyze the shareholder agreement, in most cases, it becomes a financial liability. Now, what is the bearing of it becoming a financial liability from equity? Equity is typically carried at cost, whereas a financial liability is carried at fair value. Now, what this means is that, let's say, like a company which did a Series A, Series B, Series C, Series D, E, F, etc., and Series A was at, let's say, a valuation of 100, B at a valuation of 1,000, C at 10,000, D at 1 lakh, and so on and so forth. All this money what they have raised is sitting at cost. But hypothetically, if you have to do this fair valuation for this CCPS, you will end up taking all of these money raised in previous lots, like at 100, 1,000, 1 lakh, etc., and bring it to fair value. Now, this is half of the problem. What this will mean is that you will have a big liability sitting, financial liability sitting in your balance sheet, which will erode your net worth, and suddenly like your books, your balance sheet P&L, which was looking so amazing, will not look so amazing. The second issue is that it will go and even impact your profit and loss statement. this financial liability typically will either will have like some sort of interest cost amortization or like a fair valuation reset, like which will go and hit your P&L, and like which will again come as a charge in your P&L. So it's a double whammy. If you ask me, like this CCPS, like it creates a very negative impression on your balance sheet, and B, like it also creates a bad impression on your profit and loss statement. Now, but what it does is it really distorts your whole balance sheet P&L. And again, going back to materiality, as an auditor, your materiality thresholds will go for a toss. Like if you have had to reclassify your CCPS from equity to liability, and like again, like it is not just the same amount. Like most of the time, like it will be a significantly higher amount, like which will be reclassified as financial liability. So invariably, wherever like there is a private equity, wherever there is a P fund, etc., this feature will be there. PE wants exit, and the exit clause, like while it is compulsorily convertible, many of you might be thinking that why we are talking about a debt classification. Typically, I think like equity, as we all understand, like has the residual interest, and like you can't just as in as equity, like they have the last charge, and like they have the last right in terms of company. But like because these P's also want an exit clause, there will be either an exit clause which will mention a period, like let's say 7 years or 10 years, or it will mention an event like an IPO, that before the prospectus is filed, 1 day or 5 days or 10 days, 30 days before that, there will be a redemption event. Or like it will mention that if like if the company, if the owners, founders fail to provide the exit option by IPO, then I think like the company will buy back these shares, and like the price, etc., is fixed. So because of these exit clauses and these redemption clauses, in most cases, we have seen that these CCPS takes the color of financial liability, and it becomes very difficult for the startup, for the accountant, and for the auditors to therefore deal with the new facts which emerge as a part of that, right? So this is one big issue in my experience for startups, which is their CCPS. Fixed assets, intangible asset continues to be a problem. Many of these startups would have gone ahead and upgraded their ERP. So one big issue which is plaguing this whole industry is what do you do with this ERP cost? Now with more and more subscription-based model coming in, SaaS models coming in, on cloud models coming in many cases, we are realizing that this is something like which cannot be capitalized, and has to be charged off to revenue, has to be charged off to P&L. So this comes as an additional hit for the startups, and this is something like which is important as an auditor for us to be mindful of. The typical fixed asset issue, I would say not so high like in startups, but then I think that is very much there because they don't have the right policies and processes and things defined. So invariably, like if you review their fixed asset register, there will be issues. The items which should have been charged off is capitalized. Items which should have been charged capitalized are sitting in the repairs and maintenance and all the other places. So that becomes difficult. Again, I think like most cases we have seen that fixed asset register is not proper. The componentization has not been done properly. Useful life has not been identified like correctly, and this all has implications on profitability, on EBITDA, stuff like that, right? So fixed asset, intangible asset continues to be one of the pain points as an audit. The next one is provisions. So this is one area like where as an auditor and an accountant, you need to put a lot of emphasis. Many times, adequate provisions are not carried out. Many times, like provisions are carried out, but as an auditor, like for you to check like whether those actual activities were carried out or not is an issue. Many times provisions are existing, but then like next year when the actual expense was made, it was made from another PO or another budget code, and like technically the P&L has been charged twice for the same expense like which was happened. And this previous point I was focusing on, that whether it will be some of these changes will be treated as a change, as a true up, or like whether it will be treated as when the actual expense is significantly different from the provision which was made. Will it be construed to as error? Will it be construed to as change in estimate? Will it be considered as an adjusting event as per IAS 8 or AS 4? Or like will it be considered as a non-adjusting event? So all of that issues become very, very challenging, like when you look at provisions and how do you deal with that. Now, the other area like where we see a lot of issues is regarding the correct disclosures. So many times, like the startups would have got notices from the GST authorities, from different regulators, from tax authorities, etc. And they don't create a provision for that. They don't even create a contingent liability disclosure for that. And that is something like as an auditor, you need to keep an eye on all the litigation register and the list, and making sure that adequate disclosures and or provisions are being made by the company and the client, right? Uh, Moving on, then the next issue, which is always there, is in terms of reconciliations. These startups require a lot of reconciliations because the fact that the ERPs might not be the strongest, the documentation might not be the strongest, the process might not be the strongest. So I spoke about inventory, but then like just an extension of that, inventory and sales return reconciliation uh, uh, item for an auditor to focus on. Most of the time missing. Fixed assets reconciliation is a big challenge. Many times, like a lot of especially like IT assets, etc. It becomes very difficult to ascertain whether those are there. The employees keep on moving. The attrition is high. Many of the times they take the laptops again away with them. So how do you deal with that? And as an auditor, it becomes very tricky. Intercompany balances and then especially transactions with the promoters, I think like that becomes very tricky. One area I did not talk about much was the whole related party transaction. So one of the most common errors, like what one encounters in auditing related party transactions, and is a lot of personal expenses of founders and promoters actually like coming into the company's books. So when you do related party audit, and it's not only about whether all the related party transactions have been disclosed and have been accounted for. I think like it's also important that whether from a propriety angle, like those were the right related party transactions which should have happened at the first place or not, right? Like not about arm's length, like the whole genuinity and the fact that whether those are company expenses or those are personal expenses. So that is something like which is a big issue when it comes to related party transactions. Many times, like the contracts might be missing, the approvals might be missing, the companies that approvals might be missing, etc. As far as intercompany transactions goes. So one part is reconciliation, but the broader part is around the whole governance and controls and processes part of related party, like which is a challenge. Now, bank accounts, another area of really, really big pain and challenge for auditors. Many of these companies would have so many bank accounts. There will be payment gateways like where they would be receiving money, and the whole cutoff becomes so critical, like whether like the money which was supposed to come in has come in or not. I think like there was some recent RBI announcement as well, like that the money like which is lying in their escrow account. Earlier it was escrow account, now can be considered as the startups cash as well, right? Bank balance. So this whole reconciliation of bank accounts, especially like with in the fintech industry, that's a big area of debate and contention. Vendor reconciliations, like there have been interesting situations where the vendors, and especially the likes of Amazons or Facebooks or Flipkart, etc., like they have written off some balances, and it still exists in your book, like whether you should take that income, whether you should still send out balance confirmation to those vendors, like which who now no longer have company as a list of vendor. I think like it becomes as a customer, like becomes a little bit of debate point between the founders and the auditors. So that is something again requires some attention, and the whole reconciliation of provisions and accruals and of trade schemes, of discounts, of market activities, promotional activities, of warranties, of litigation, etc. Like, is this something like which is a cause of concern? So these were the areas like which I had for today. Thank you so much to the entire audience for participating on Menti. We will hold back the Q&As till the end of the session. You can scan this barcode. This will take you to my LinkedIn profile. You can feel free to message me for any of your auditing concerns or accounting concerns. We'll be happy to answer them. With that, I will stop sharing. I will hand it over to Vineet for continuing with the session. Thank you all again. Vineet, over to you.
Thank you, Rahul. Yeah, please, Vineet. I was just about to invite you for the same.
No, please, you may say whatever you want to say first.
I was very enlightened with the points Rahul made about the provisions and the revenue and the critical classification which I was talking about, or the categorization of the expenses or the revenue also. And one thing I just wanted to point out and appreciate about Rahul, that we were talking about startups and innovations is not a very far off topic from that. And the innovation which you used today in the interactions part was very new to me. So thank you for that. And now I would like to invite Vineet, CA Vineet, for the further deliberation, please.
Thank you, Apurv. Thank you for inviting me. Thank you, Rahul, for such an insightful deliberation. Thank you for enlightening us. Very thoughtful and very engaging through the Menti app that you just did. It was a very nice idea. Hello, good evening, everyone. My name is CA Vinny Jain, and firstly, I'd like to start by thanking the AASB for having me here today and giving us the opportunity to speak on the audit of startups. Thank you so much, Sanjeev sir, Vishalji. Thank you so much for inviting us over. And thank you, Akash, CA Akash, for wonderful welcome note for us. And CA Apurv, thank you. And to all the members, hopefully through this deliberation, we hope that you get some useful insights and get some meaningful knowledge with regards to audit of startups. So quickly jumping on to the topic, since we are running short of time, I'll try to keep it brief. And I'd just like to share my screen now. Okay. Yeah, is my screen visible? Okay. So, yes. Just a minute. Is the screen visible again? Sure. Yeah. So key considerations in the audit of startup are so before I start, I would just want to give a brief about what startup is. As C. Rahul just mentioned in the beginning of his deliberation, there's no specific uh, definition as to how we define a startup. But yes, we can definitely identify any business venture or any business model as a startup through some of its characteristics. And the basic characteristics, I particularly personally bifurcate the characteristics of a startup into three broad heads. The first one is innovation, the second is growth oriented, and the third is risk and uncertainty. So when we talk about innovation, startups are majorly based on any innovative idea which a founder may come across and started as a business venture. Usually, a startup is built on the basis of any new idea or a product that offers a unique approach to solve a complex problem that is existing, and it is different from what is already existing in the conventional form of a business in the market. So it has a differentiating factor from the conventional approaches of business, and yes, offers an innovative solution to some existing problem in the market. Then when we talk about growth oriented, majorly startups are focused on growth, on scalability, or building a scalable business. This predominantly means that the goal is to acquire a huge customer base or revenue eventually, and expanding the market presence. Basically, startups are focused more on the growth and the scalability part. Initially, the ride may not be a smooth one when the startups said to venture in, but then eventually, yes, their major or main objective is to gain scalability in terms of the market share as well as gaining revenues. Obviously, making into a profitable one, not always running into losses. But yes, startups have this growth orientation that is there. But on the other hand, when we talk about the growth orientation, there is also significant risk and uncertainty involved in a startup. So when we talk about risk and uncertainty, they operate at a comparatively higher risk as compared to other players in the market, because it is not just related to the risk is not just related to any business idea or a business model. It may also be dependent on the market dynamics, the business environment that the startup is operating in, and there are other multiple external factors that definitely um, affect the operations of a startup. So although the risk and uncertainty in case of a startup is higher, but then higher the risk, higher the rewards. We keep hearing this since the whenever we keep studying earlier also. But in case of these startups, if the risk is high, the reward is high, and if the startup succeeds, they may end up reaching such numbers or maybe valuation that the conventional businesses in such a short period of time will not be able to achieve. So basically, when we talk about the startups, um, uh, these are the three basic categories that exist, which is uh, the uh, innovation, growth oriented, and risk and uncertainty. But when we talk about the startup ecosystem in India, so there is this is a short landscape that is there. Basically, when particularly in Indian startup ecosystem, that as of 2023, particularly the startups have raised a funding of more than $141 billion, out of which 5,300 startups are uniquely funded startups, and with the total seed stage funding from exceeding $5.7 billion. In fact, right now, in terms of the merger and acquisitions, deals and exits, there are about 1,200 startups that are there who are undergoing the M&A deals, and more than $6 billion have been spent on the M&As. And in fact, as of 2023 ending, 18 startups have undergone for IPO, and there are 22 other startups that are upcoming for the IPOs. And out of this entire startup ecosystem, 108 startups have become unicorns. Like by unicorns, we mean that they have touched the valuation of $1 billion, $1 billion. And 106 startups are in the category of soonicorns, maybe soon to become unicorns. And they have a combined valuation of more than $345 billion. So in a sense, the startup ecosystem is has a huge market space, and they are increasing from a huge sense. And this way, for us as auditors, it becomes really very important to assess and perform our auditing procedures, since with the scope of startups increasing in the markets, the scope of risk is also increasing, and which is obviously an eye raiser for the auditors, for us as the auditors, while we are applying our auditing procedures, or basically applying a professional skepticism while auditing these startups. So, key challenges that we face while auditing these startups. So there are basically, we bifurcated these key challenges into 8 broad heads. I'll be speaking briefly about them. So the first one is unique business models. Startup companies are based on innovative businesses that are also new for auditors to understand and assess. And the auditors need specialized knowledge and expertise to understand the business model and associated risk. Startups, since I just mentioned at the very beginning that they are based out of some, a unique idea solving some complex problem, there might be the business model may be such that we may or may not have come across earlier. So this unique business model may be a challenge while auditing the startups. The second one, which is an important one, is the limited internal controls. So startups operate with less formalized internal control processes and documentations. And this is usually founders do not understand this. This is very critical for the founders as well as the auditors. Majority founders come from a tech background and they do not understand the importance of internal controls. Usually startups are in a myth that they are relatively small, so they do not need any kind of internal controls, or they they think that the investment in the internal control processes and documentation at the early stage in itself is of no use. But when in no time they cross at least a 50 crore threshold, maybe they become eligible for an IFC audit also, and they may not be ready for it, and it becomes very difficult for them to justify to the auditor. And we as auditors also, it becomes really very difficult to cope up with these gaps that are present there. And in fact, since past 1 year, the focus of the investors has also shifted towards the internal controls and how these startups are facing issues due to weak internal controls. So limited internal controls is another challenge that one may face during an audit of startups. Then the third challenge that we may face is subjective estimations. By subjective estimations, we mean that heavy use of estimates in startups is often limited to historical data and requires auditor to exercise a higher degree of professional skepticism. Since the startup, with the limited availability of the benchmark and or the thresholds, and limited availability of the past trends because of a new kind of a startup operating in the market, it becomes a little difficult to ensure the estimations, get the estimations, and whatever estimations also one may get, they may be subjective. They may be subject to different questions, different other logics that different people may have. So this is another key challenge while one may face while auditing the startups. Then the fourth constraint is the resource constraint. And this is one of the very critical challenges that startups face, because resource constraints in startups can lead to incomplete records and financial gaps in financial reporting. Auditors must account for limited personal and financial resources, which may impact the timing and scope of the audit process. Since these startups, they have limited resources in the beginning stage, or at the early stages, they may or may not be able to get the required resources or the required talent. And even if we end up getting the required talent to for their day-to-day operations, including the financial reporting, they may not be able to retain the talent, which definitely may create difficulties or maybe challenges for the startups to run smoothly, and this also has an impact on the audit. Then the fifth challenge is pressure for growth. Or the startups are under immense pressure to demonstrate growth, which can lead to aggressive accounting practices, increasing the risk of misstatements, whether due to errors or fraud. But due to investor pressures, a lot of startups may or may not end up getting into the aggressive accounting practices. Auditors must be vigilant of the management's bias towards portraying a favorable financial position. because in order to in order to scale up the business, startup may seek funding whether in the form of debt or equity. And in order to get, in order to raise those rounds of funding, the startups may, use the accounting practices that may or may not be right, and that also raises the risk for an auditor. Then the technical accounting, the auditor must deal with the accounting for equity instruments, revenue recognition. We've just discussed about various accounting challenges and the techniques which CA Rahul just mentioned about in his deliberation. The capitalization of development costs. So there are other technical accounting which is involved in the financial reporting of the startups. And obviously, when we are auditing the financial statements, this technical accounting aspects play a key role. Maybe accounting related to ESOP, equities, revenues, all of these, they have definitely can be a challenging role when auditing the startups. Then the other point is, which is very important, and I'll be talking a little more elaborately on this part, is the going concern. The auditor must critically assess the startup's ability to continue as a going concern, especially given the high burn rates and uncertain funding prospects, characteristics of early stage companies. Going concern is a big question mark when we are auditing these startups. So it is very important to assess whether the startup is operating on a going concern basis, and whether they are factoring all of those considerations, which reduces the risk of going concern uh, for a startup. Then the last, but not the least, the challenge is cybersecurity. Since majority of the startups are based on emerging technology, cybersecurity has become a major concern for the auditors. The auditor needs to assess the risk of cyber attacks and the effectiveness of the company's controls to protect against them. So since a lot of tech is involved nowadays with most of the popular startups, if you even see as an example, maybe all the e-commerce platforms or any other startup that you come across on a day-to-day basis, you may realize that these startups possess a lot of confidential information pertaining to yourself or personal information in their database, may it be your name, your contact details, email ID, your address, your credit card details, even. So these possess major risks when risk due to cyber risks or any other areas where the data may get exposed. So this is a major area wherein the auditor may face key challenges while auditing the startups. So when we talk about these key challenges, characteristics, although the startup ecosystem, it is an emerging area, and though the auditing is a little new, it is complex. There are new trends coming in. But yes, we as chartered accountants have been cracked the ways and been dealing with all the uh, auditing procedures while auditing the startups, may it be at the planning stage or the substantive testing or the concluding parts or internal controls. All of these play a critical role while auditing the startups, whether it is an emerging startup at an early stage or it is the startup which has come for reasonable size or has huge funding on board. Irrespective of all of these players, the auditor needs to apply professional skepticism in all the areas and ensure that the financial reporting is correctly done. Moving ahead, as I just mentioned, I would be majorly talking about the going concern aspect. And going concern is a big question mark, as I just mentioned. And the majority of the startups are dependent upon huge funding, either in the form of debt or equity. So during the early stages of a startup, huge cash burns exist. And a lot of expense is incurred, whether on the development of the product or on customer acquisition or building a suitable team. And this may lead to negative cash flows, and which may wipe out companies, maybe capital, or may put a question mark on the company's going concern. So this is a very critical area when we are talking about the auditing of the startups, especially the early stage startups. So how do we assess the going concern? So there are a few factors that are involved in the going concern assessment. The first one being the startups often rely on the continual injections of debt and equity funding to fuel the growth. And this dependence creates a risk profile that fluctuates with market conditions and investor fund sentiments. Then there is heavy reliance on loans, exposing startups to the risk of high leverage and significant financial commitments, affecting their operational flexibility and increasing the scrutiny on their ability to meet obligations. So significantly high leverage may lead to high burdens and therefore high risk. Startups often operate in rapidly changing markets. High revenue volatility and uncertain market conditions can severely impact the going concern assessment, necessitating more dynamic and frequent valuations. So because of this dynamic environment, startups need to cope up with the changing ways, and maybe it may have an impact on the revenue and other areas of financial reporting. Then, in the sectors driven by rapid technological advancements, there is a constant risk of products or services becoming obsolete. So, as I just mentioned, that the startups are continuously based on some kind of an innovation, they also need to ensure that the innovation keeps on happening or the developments and the innovations keep on happening. Because with so much competition and so much technological advancements, their existing products or services may even become obsolete in very short period of time. So this may also raise a question mark on the going concern. Then startups often depend heavily on a small team of key individuals. The loss of such personnel significantly, disrupt operations and affect the company's ability to continue as a going concern. So especially the human resources especially the key employees who are a part of the startup and looking after the highly technical areas or the key areas, getting the right people on board and retaining them is very important. Otherwise, this may impact the workings of a startup, and may also going forward there is a question mark on the going concern. So these are the various factors on the basis of which one may assess the going concern while auditing these startups. But and then there are various factors that are involved in, in influencing the going concern concepts. Then basically, if we bifurcate these factors, they are broadly bifurcated into four parts: financial health, market conditions, management competence, and investor confidence. So when we talk about the financial health, regular assessment of the liquidity ratios, profitability, and cash flow projections, positive net cash flows, and manageable debts are the key for the financial health of a startup. Then the second one is the market conditions, market trends, competition, and economic cycles affect a startup's risk level. Third one, management competence, effective leadership, and strategic decision making are very critical to any startup's success. Then the investor confidence, a strong track record and transparent communication with the investors, with a good vision and a good maybe exit plan for maybe infused equity in the company. This raises bar for the investor confidence. So these are the broadly four factors that may affect the going concern, that may have influence on the going concern. But talking about the assessment of the going concern and factors that are influencing the going concern, what challenges do we face as going concern in startups? The first one is the cash burn rate, where regular financial assessments to manage cash burn and identify potential shortfall is very necessary for the for the startups. Then where they're usually dependent on external fundings and they're not generating positive cash flows and maybe profits, for them it is very important to manage this cash burn and also identify the potential shortfalls. Then the second one is dependency on funding, diversifying the revenue streams to reduce dependence on external capital. As the sooner the startup becomes independent, self-sufficient, the better it is for them, because at the end of the day, maybe it is in the form of equity. If they get funding in the form of equity, they need to maintain the investor confidence and ensure that eventually the investors get the expected returns, and if they are funding in the form of debt, then definitely they have a pressure of repayments and all the interest costs. So this dependency on funding is another challenge. Then the third one is the market volatility. Scenario planning and risk mitigation strategies can enhance the resilience. So if the market is very volatile, it is very changing at all the times. So definitely risk mitigation plans and strategies are very important. Then legal and regulatory compliances. Regular legal audits and adherence to regulation levels are very important to ensure legal and regulatory compliance. And then contingency planning. Having plans for worst case scenarios to ensure preparedness is another way where you know, although startups face this kind of a challenge in the readiness and preparedness for the upcoming challenges, but then this is another area where there's challenges in the going concern. Then how do we mitigate the risk in the early stage startups? There are basically five main areas where we can five broad heads which we may use for mitigating the risks of going concern in the early stage startups. The first one is market risk assessment. Thorough market research to identify the potential risks, analyzing competitors, target audience, and trends. So this would help to identify the market conditions better and penetrate better into the market. Then the second one is the financial risk management, creating detailed financial projections and monitoring expenses continuously. It would help channelizing the funds and maintaining positive cash flows so that the day-to-day operations are met. Then talent acquisition and retention, attracting top talent through equity, flexible work arrangements, and a compelling vision is very important. If the right kind of talent is on board at all the times, it plays a key role in the success of the startup and also continue it as a going concern. Then product development risk, using agile methods, iterating quickly, and involving users in the development process. So product development risk exists, but yes, continuous improvement and continuous innovation, the product development risk can be mitigated. Then the last one is the strategic partnerships and alliance. For a startup, it is very important, especially in the early stages, that the startup chooses the right kind of partners and who have an alignment with their goals and have a vision plan which goes hand in hand with the vision of the startup. So this is very important, and this can play a very good role in mitigating the risk and giving a startup a long way journey. Then moving on, this was about the going concern. So particularly when we talk about the going concern, and apart from mitigation plans just mentioned now, there are other techniques that one may use to uh, apply as audit procedures to get more comfort on the going concern. Maybe using of the balance sheet approach during the scope and strategy of an audit, whether entity is in a net liability position, and investigating more into the significant liability, especially due within the reporting period, and inquire the management regarding the plan to satisfy the obligations, is a one way wherein you can check the going concern concept and also see where if, the impact of the if any discrepancies exist. Then obviously timely review and timely and ongoing review of the going concern assumption and recoverability of the assets. These are the few ways wherein you can see how the going concern concept uh, can get more comfort on the going concern and mitigate risk related to going concern. Moving on, when we talk about, there are a lot of internal controls. We just mentioned, as I just mentioned in the beginning of my deliberation, also a lot of startups, especially the founders, since they're based out of their background is majorly of tech, they do not understand the importance of internal controls. But yes, presence of adequate internal controls is very important in the success of any startup and get a comfort as for us also as auditors. And when we talk about these internal controls is a process by an entity's board of directors, management, and other personnel designed to provide reasonable assurance that information is reliable, accurate, and in compliance with applicable laws, regulations, contract policies, and procedures. And when we talk about the internal controls, you may bifurcate the internal controls into two broad heads, which are the entity level controls and the activity level controls. So when we talk about the entity level controls support corporate culture and values and influencing the staff performance. These controls provide a basis for the lower level controls, ensuring effective implementation of all the internal control components. So, and then various key entity level controls are like policy and procedure manuals, whistleblower policy, risk assessment process, code of conduct, controls related to the control environment, monitoring of lower level controls, controls over period and financial reporting. So these are the various broad heads of the key entry level controls that should be present in a startup, irrespective of the size of the startup or the stage at which the startup is present at. Existence of entity level controls is very important in order to get comfort for us as an auditor. The more effective the entity level controls are, the better it is for us in forming a judgment and giving a better opinion on the financial reporting. Then the second aspect is the activity level controls. Activity level controls are concerned with a specific type of transaction, account balance, or financial statement disclosure. And a business has 3 to 6 significant different business activities, which may include sales or accounts receivable or revenue recognition or cash collection. The second one, purchases, accounts payable, expenses, cash disbursements. Third one, inventory. Fourth is debt or interest expense, and then hiring and payroll. And for all of these 5 broad categories, which may or may not be present across all the business ventures or startups that are present, activity level controls at each of these areas is very important. And different activity level controls need to be implemented, and we as auditors need to check the effectiveness of these activity level controls, whether how strongly they are in place, and what is the status of these controls, and whether we can get comfort on these controls or not. So there are a few other examples of activity level controls. These are those controls in which of these activities will affect a more limited portion of the financial statements and will directly affect the nature and timing of other auditing procedures for that activity. So a few of the examples include segregation of accounts payable transaction processing from bank reconciliation, security of the assets, approval requirements for new vendors onboarding, review of operating performance, regular bank account reconciliations, time card approval policies, authorizations for pay rate changes. So these are a few activity level controls at different level and different among across different areas. If it implemented effectively, may give an added comfort to us as auditors, and we may be we may be in a better position to give a clean audit report. So this was about the um, activity controls and the entity level controls, and we just spoke about the going concern issues and general discussion about the startup ecosystem, especially in India. And that is it from my side of the deliberation. Thank you so much, and I hope you found this deliberation to be insightful. If you need to contact me, my details are just mentioned on the screen right now. And once again, thank you to the ASB for giving me the opportunity to speak on this topic today. Thank you.
So, thank you, Rahul sir and Vineet sir, for your insightful presentations on the key consideration in the audit of startups. We appreciate your time and effort in sharing your experiences with us today. Now, we shall proceed to the Q&A session.
और सर कोई क्वेश्चन हो तो आप प्लीज पूछिए.
Yes, sir. There are a couple of questions. So Rahul, sir, I would like to address this question to you. So this question says, can a trading company, which is otherwise following the startup criteria for turnover, the constitution, the date of incorporation, but it is engaged in trading activities. So will it be given the income tax exemptions? Will it be eligible for that?
Right. So thanks for the question, Apurv. Honestly, I'm not an expert in this area, in terms of like whether this entity will meet the criteria or not. What I understand, looking at some of my clients, I think many of the uh, uh, innovative startups have made applications, and like their applications have been rejected. And in many
Right.
cases, like I've also seen that people who are more into, let's say, traditional businesses, but like just modern way of doing things, and like the way their applications have been made, I have seen that those applications going through. So I think like as of now, it's not like a really set process as far as I understand, and there is a degree of judgment involved. So that is what I have seen, but like without understanding more in the nature of business, I think I don't know like if I will be able to answer that appropriately. Yeah.
Okay. So I just extending the same question. So e-waste is a very good startup business which is in talks. Very battery hai, all the e-vehicles coming in play. The
Right.
battery waste which will be generated in the near future, maybe 4 to 5 years down the line.
Right.
So I was listening to a video or listening to a content on this, and so the e-waste segment, I'm just taking e-waste as an example, not asking any specific question through e-waste. So basically, there are businesses which relate to collecting the scrap, collecting the waste as a combined, and then extracting or sorting out the waste material and extracting the lead, the elements which are actually of use and can be reused for
Right.
further manufacturing of batteries. So
Right.
the extraction and the trading of those specific elements are the nature of business of a few startups, which is going to be in the future and is also happening currently. So can this be a classification for manufacturing, service, trading? Because they're getting their revenue from trading, but they're not exactly manufacturing anything. They're just extracting and sorting out things. So where would you classify this? And I just want some insights on this.
Right.
I hope you understood my point.
I understood the question. Vinith, you want to go ahead first, and then maybe I can add?
Please.
So especially when you're talking about the e-vehicles, and when they're increasing, and particularly when you're talking about the waste, so you meant that the EVs are wasting. I mean, can you just repeat this?
Yeah, so I'll just repeat. Firstly, I'm not asking anything specific to the e-waste business or anything like that. I'm just taking the e-waste industry as an example. There
Mhm.
might be other innovations in the similar fields also, but
Mhm.
the e-waste company, what they will be doing that, and a similar sort of companies are doing right now. They collect scrap, they collect
Mhm.
waste, and then they sort out material out of that,
Mhm.
which can be reused as it is. They're not manufacturing it. They're not uh,
Mhm.
doing any sort of job work on that so as to make that usable or any of that sorts. They're not doing it. They're just extracting the material out of the waste they collected, and they're just sorting it out.
Mhm.
So and after that selling that. So their major revenue generating activity is actually trading,
Mhm.
but they're not manufacturing anything, and they have not exactly purchased the specific material which they're selling.
Mhm.
So, what would you categorize the segment in? Manufacturing, trading, or service? Because this
So
is
basically, it is, there's nothing manufacturing going on, but yes, there is
correct.
sale of goods
Exactly.
involved. So it is definitely, it will fall under the trading category. And honestly, there are many waste to wealth startups that are now coming up. This waste to wealth kind of a concept has come into picture nowadays, wherein
Okay.
people are not only extracting the useful products from the waste products, but then in fact recycling or maybe some other
Exactly.
process
Yeah.
that is also involved. And in that process also, some part of the, you won't say that it is being manufactured, but it is reprocessing. So even that also you cannot say that it is being manufactured. It is just being recycled and then maybe reused and sold further into the market. And similarly, when you talk about just picking up the material and selling it out of the waste, it will definitely fall into a trading business. And not only, and for particularly for this kind of a startup, when we talk about, there are a lot of other sustainability benefits that they may.
Exactly. This was what I was coming to.
So it may fall under this new age consulting that is coming up, ESG. If you talk about, it may fall under that. There are a lot of benefits and there are a lot of incentive programs, not only from the government but also from the private sector when they need to comply for ESG. These kind of startups have a huge scope of growth, wherein they can collaborate with different industries and definitely contribute to sustainability.
Exactly right. Exactly right. So, these sustainability programs and the plastic reuse and the plastic processing companies which are already existing in place are the ones which I was referring to in current scenario, and the e-waste which will be generated in future. So, because they are the similar kind of industry and taking the things forward. So, this was the question. Now, Akash might have a couple of questions also.
Yeah, actually, so my question would be like, how do auditors, we as an auditor can communicate audit findings and recommendations to the startup founders and investors who might not have a strong financial background?
Right. So, good question, Akash. I think the answer would lie in more frequent communication and like I think like most I would say smart auditors would like depending on the frequency of their auditors, right? Like audit whether they are doing it annually or quarterly. Like at the end of audit, like would have a or rather should have like that closure meeting with the
Management.
investors, founders, management.
Hmm.
They like mostly I think like you have this whole governance of having an audit committee, of having, if the audit committee is not there, I think the board. So I think like so that governance exists in many companies, many startups, e-commerce companies, because they have Ps. And they insist that even though like it might not be required statutorily for them to have an audit committee, but many of them still have that. And I think like it's a common practice that the auditor, the main audit partner, has like a conversation with the chair of audit committee, or like even with the board, with the different stakeholders, and they do put across like what has been their experience of audit, like some of the risk they see, some of the things like which the company should be doing going forward. So I think like that communication is the answer. I think many of them do it, and if others have not been doing it, I think that is something like which can be done. I also know that many of the auditors insist that they should be part of the entire board meeting, and not or like all those senior management companies, and not like just their section, like where audit report is being presented, so that like they have better insights of what's happening in the company, and use that as a channel for communication. So this is at least what I
Yeah.
have seen. Yeah.
Okay.
Yeah, I would like to add on in this. There is also
Hmm.
one concept of management letter. And today's scenario in this startup ecosystem, when we talk about, the founders are very smart. I mean, they are, when you sit with any like proficient founder, and while auditing or just interacting with different people working in different startups, they are very thorough and they are well aware about the regulations and everything. But still, we as auditors, when we have certain observations or findings, a management letter is a good way wherein you can, even though if you even if you're issuing a clean audit report, you through the management letter you may point out your observations, the responses that the client may have, that the startup management may have. And on the basis of those observations and the responses, we can definitely draft in conclusions and present it in the form of a letter along with the audit report. So this may be another way wherein the startup founders and the investors may be communicated more on the audit findings that exist during the audit.
Okay. Yeah. And one more, like, can we give purchase preferences to startup companies in tender processing? Currently we are giving to MSME cases, they get preferences in the tender process.
I mean, is your question in the terms of the context that whether it is allowed or whether government gives a preference to them?
Currently, government give preferences to MSMEs. So my
Right.
question is that can startups be given such type of preferences or not? Government should promote startup in this way, or
See, personally speaking, the government, if the government has a scope, there are a lot of work that is going on within the government, and the government may or may not give. But yeah, if the government give, it would be a good big boon to the startup ecosystem, honestly. And since the Indian startup ecosystem is third largest in the world, and if you wish to, go on to the top, if government introduces such schemes where then they are introducing more schemes for growth for startups, then this would be a good move for the startup to get good revenue, a good top line, and maybe run into positive cash flows.
Okay.
so Apurv,
Uh, just one question. I don't know exactly how to frame it. I'll try to explain it well. So it's related to the provisioning and the valuations. There might be cases in a startup where the provisionings and the valuations are done on the basis of, they're usually done on the basis of past historic data, the trends, and if any specific method of calculation or the assumptions which have been taken. Now, because the startups are already innovative in their space of work, so there might be lacking a lot of historic data so as to compare them for the trends. But based on their own assumptions, the company policies, the provisioning might have been done, which on explanation of the management might feel justifiable, but does not go with the actual guidelines given by the institute. So, how to take a call on that? How to foresee that?
Right. So that's a tough one, Apurv, and that is the practical challenge of dealing with this, right? Like both as accountant and as auditor. So one, I think like you have to look at your own trend. If the own trend do not exist, then I think like you'll have to look at what is the industry benchmark, and I think that is where experience comes in, right? That like if you're talking about a sales return percentage for a product company, 1% might not make sense. Like if the industry trend is 10% or 12%. Likewise warranty claims, etc. So I think like the second stage would be more of benchmarking and industry trends. And third, finally, I think like what will be most important would be to at least be slightly more conservative, like right, like if you don't have enough data. So that I would in the sense that if you have to if you have enough data, then it's a separate matter. But if not, then at least like if there are aggressive provisions which are being made, like the auditor should challenge that. At the same time, like if there isn't any provision, like the auditor should also challenge that, right? So balance, and then I think like having a slightly more conservative approach in terms of accounting for provisions and litigations and accruals, I think like might be the better way forward.
Okay, okay,
okay.
got it.
Cool. Great.
So thank you, sir. Your questions or your answers have added great value for to our discussion. Now, to formally conclude our webinar, I would like to call Anil sir to deliver the vote of thanks.
Thank you, Akashji. First of all, thank you so much, Rahulji and Vinijji, for such a wonderful deliberation. Both of you have covered all the aspects relating startup, and in the way Rahulji has covered with the various aspects, it's hats off to you. It was wonderful deliberation, Rahulji, and Vinijji, you have covered the rest of the part in a very efficient manner. So, on behalf of AASB of ICI, I extend heartiest thanks to our the learned speakers, Rahulji and Vinijji, and two young moderators, Akarji and Apurvji. So, thank you so much on behalf of AASB of ICI, both of them for sparing their time and wonderfully moderating this webinar. So once again, on behalf of AASB, I extend heartiest thanks towards all the four learners speakers. Thank you so much, Rahulji. Thanks, Vinayji. Thanks, Karthik. Thank you so much.
Thank
everyone.
you.
Thank you,
And
sir.
I also thanks
Thank
all
you.
the participants. Thank you.
Thank
so
you,
Thank you.
everyone.
Thank you. Thank you.
Thank you for the kind words. Have a good rest of the week. Thank you.
Thank you. Thank you, everyone.